Krista Gardner. I am a partner at SEK CPAs and Advisors. I am located in York, Pennsylvania, and I live and breathe government and not-for-profit. That's all I've ever done, and I enjoy it, which I've been told is I'm a little bit of a unicorn, but live and breathe accounting in the government and not-for-profit world.
I share the same affliction that Krista does. I really enjoy the local government work. I enjoy night meetings most of the time. You get to see a lot of people and work on some really unique issues. I've been an attorney at Salzman Hughes for almost 16 years, and I practice pretty much primarily in the municipal field. And before I forget to allow Marie to do her introduction, Marie, if you could introduce yourself now before we get to your part.
Yep, absolutely. Afternoon, everyone. I'm Marie Holland. I'm with GMS Funding Solutions. GMS is a consulting firm that specializes in securing grants and low interest loans for capitally challenged projects. Our clients consist of municipalities, counties, nonprofits, and a variety of private entities. And essentially what we do is dissect project budgets and align costs with applicable funding sources. Then we assist our clients through the award process, compliance, drawdown, and closeout audit. And so later in the presentation, I'll be covering some of those compliance and reporting requirements for the ARPA funds.
Being a presentation by a lawyer, we've always got a disclaimer, right? So this information is as up to date as we can make it. We endeavor to stay on top of the Treasury guidance. As of my last check at about 11:30 today, I don't think Treasury has issued any new guidance, but they are consistently updating regulations and providing additional information. There are nuanced facts and circumstances that each municipality may have. This is supposed to be a general presentation to cover general information. So you should talk to your accountants, your legal advisors, and other consultants that you may have as to how those facts apply to your particular circumstances. So with that and with that general overview, we are going to dive into the agenda today. First, we're going to cover some basics about ARPA, and then Krista is going to touch on a really important topic for everyone, and I'm excited to hear this information, and that's the revenue piece. As you all may be familiar, you're allowed to use a portion of the funds for revenue loss, and Krista is going to tell us what is revenue and how do you calculate that loss. Then we're going to get into a general discussion about uses of the funds. This is a municipal-centered conversation, so we're going to try and focus on some of those governmental uses more than some of the other uses. Marie is going to talk to us at the end about reporting requirements, and then we are going to try to preserve some time for discussion. So the basics, I'm not going to spend much time on this because you're probably all familiar with this. We're talking about the American Rescue Plan Act, which became law on March 11th of this year. Portion of that act established the coronavirus local fiscal recovery fund. It was funded in the amount of about $350 billion allocated to various public entities, which included counties and metropolitan cities, which has a direct allocation to those counties and metropolitan cities of 50% in 2021 and 50% in 2022. As well as an allocation that passes through the states to what the Act refers to as non-entitlement units of local government, generally those units of local government that have a population of less than 50,000. I do want to point out that if you've joined us today and you are a non-entitlement unit of local government and you have not yet applied to DCED for those funds, you need to do that as soon as possible. There are administrative things that you have in place to be entitled to receive those funds. DCED has extended the deadline for non-entitlement units to apply for those funds, and that deadline is now July 29th of 2021. We've heard from a lot of folks that they had some difficulty with their SAM registration, so you want to make sure that you're on top of that now. So I'm encouraging you, if you haven't applied to DCED yet, please do that as quickly as possible. If you need some help doing that, please talk to your funding consultant, your accountant, your solicitor, or whoever helps you with those types of things. Also wanted to note, we've got some folks who have joined us that aren't from a municipality, but are from perhaps a municipal authority, a special purpose unit of government. While those municipal authorities did not receive a direct allocation of funding under ARPA, special purpose units of governments are permitted to receive funds through an entity that has received funding. So for instance, a county, a metropolitan city, or a non-entitlement unit of government may provide subrecipient funds to a municipal authority. And some of the eligible uses that we're talking about today will be most interesting to folks that are involved with a municipal authority. So what do we know so far, and what is this discussion going to be based on? Well, Treasury has issued an interim final rule, which is kind of their draft rule setting forth how the program will be administered. The public comment period for that rule is open through July 16th. So if you do have any public comment regarding the rule, you can submit that to Treasury and they will consider that prior to making the rule final. And Treasury has also updated some frequently asked questions. We're on our 6th edition of the FAQs. They've been updated with the most recent update being June 24th. So that's what we're basing our discussion on today. There is, I want to remind everyone, kind of a general eligibility test that we'll refer back to throughout this presentation for the use of the funds. And it's a two-pronged test. And the test is, number one, you should first consider whether there's an economic harm that exists and whether that harm was caused or made worse by COVID-19. And the use of the funds must respond to the identified negative economic impact. And that use has to relate and be reasonably proportional to the extent and type of the harm experienced. Uses that bear no relation or are grossly disproportionate to the type or extent of harm experienced would not be an eligible use. So by way of a quick example, the FAQs do say that a recipient could potentially do a distribution of funds to households within the municipality, kind of like the stimulus money that a lot of households receive from the federal government. But the regulations say that you should use the federal distribution of those stimulus funds to households as a gauge of reasonableness. The federal government determined that those stimulus monies that were directly allocated to households reasonably responded to the pandemic. You've got to make that judgment as well. Will that use of the funds respond to an identified harm? Funds must be obligated no later than December 31st, 2024. Don't have to be spent, but obligated no later than December 31st of 2024. That means if you've got a project that you're going to award a bid for, you should have that bid awarded by that time. If you remember with the CARES funding, there was a lot of emphasis placed on the meaning of incurred, and ultimately Treasury came out and said, we'll consider incurred to mean you've entered into a contract for the expenditure of those funds, even though the funds may be expended later. But there is a back end on when those funds must be expended. And so those funds must be spent no later than December 31st, 2022. So out of your accounts and into the hands of the folks who are receiving those funds. That's the hard deadline for the expenditure of these funds. So with that as kind of the basics, I am going to turn it over to Krista to talk to us about revenue. Krista, you're muted.
There we go. Sorry about that. I'm so worried about sharing my screen. So as we talked about, revenue loss is this big topic that everyone's trying to figure out what it truly means. So what I'm going to do is first walk through the calculation. Then I'm going to talk about what they mean by general revenue. As you'll see, I've got that in quotes because that's what the FAQs and the interim final rule are calling it. And then we'll get into an actual example using the GFOA's template, and then a couple other just reminders. So first off, what they are allowing is essentially if the recipient has experienced revenue loss, then you can use those funds in a much broader aspect, which we're going to get to. How they calculate this revenue loss is, first of all, we have to use 2019 as what's considered our base year. They are then giving us what's called a growth factor of 4.1%. So essentially you take your 2019 general revenues, you add 4.1%, and that's what I'm calling is kind of that predicted 2020 revenue, or quote unquote general revenue. Then we take our actual 2020 quote unquote general revenue and compare the two. If our actual comes in less than that predicted amount, that is lost revenue. If our actual comes in over the predicted amount, there is no lost revenue. So to show this, an illustration here, I have two examples. Example one on the left, the 2019 general revenue, our base year before COVID, $100,000. That growth factor that they're allowing us to use of 4.1% essentially says our general revenue should grow from 2019 to 2020 by $4,100. The 2020 predicted revenue then is $104,100. So then let's take a look at what our actual revenue was for this example. And I made it $102,350. So the difference between what we predicted on line D and our actual revenue for 2020 line E is $1,750. So essentially based on that calculation, this recipient would have $1,750 to spend in a more broader category under that lost revenue. Example two on the right, same factors, except for the actual revenue for 2020, I made $106,500. Now, when we compare that to that predicted revenue of $104,100, we actually had more revenue, and therefore it's a negative revenue loss, and therefore this recipient for 2020 would not have any funds in that category to spend. Obviously, there are 4 other categories that money could be spent, but essentially under that revenue loss category, example 2, there were no funds to be spent. Example 1 in the green, they would have $1,750 to spend. Now there was a little asterisk by the 4.1%. So everybody can use 4.1%, or you actually could use higher than 4.1% as your growth factor if your actual growth the 3 years prior to that, meaning the 3 years up to 2019, were average higher than 4.1%. So that growth is going to go from 16 to 17, that's 1 year, 17 to 18, that's year 2, 18 to 19, that's year 3. And so I have a nice illustration here because I think it's easier to follow. On the left, example 1, I have general revenues from 2016 to 2019 going from 100,000 to 110,000. You can see my growth is calculated for 3 years there on the right, 6.5%, 1.27%, 1.99%. That's an average growth for this recipient of 3.25%. In this scenario, this recipient would use the 4.1% to calculate their revenue growth because their actual is under that amount. So they're essentially saying everyone can have at least 4.1% growth. But in example 2, I altered my revenue numbers a little bit higher, and you can see my growth for the year is 6.5%, 3.49%, 6.3% for an average growth of 5.46%. This recipient would replace 4.1% in their calculation with the 5.46%, giving them the opportunity to essentially use the higher of the two. Now, that's how we calculate it. And there is a nice tool. There's several tools out there, and I'm going to walk through the GFOA tool. But now let's jump into what revenue or general revenue means, which I think is the hot topic item everyone wants to go over. So what the interim final rule essentially is saying is they have this definition of general revenue that they're saying, and a lot of this language comes directly from either the interim final rule or the FAQs. I do recommend going out to the Treasury site, going to the frequently asked questions document. It's nicely laid out, very easy to read and understand. So most of this information came directly from that. They're essentially saying our definition of general revenue is based on, but not identical to, the Census Bureau's concept of general revenue from owned sources. And I like to point out that general revenue from owned sources because really that is the true nature or spirit of what we're considering general revenue. It's revenue that the recipient itself essentially is generating or creating, or something that the recipient is doing is bringing in that revenue. So the Census Bureau's definition essentially states all government revenue except liquor store revenue, insurance trust revenue, and utility revenue. The basis for distinction is not the fund or administrative unit receiving particular amounts, but the nature of the revenue sources concerned. So again, it comes down to the recipient creating these revenue streams, but they specifically state no liquor store revenue, insurance trust revenue, or utility revenue. So let's take that a little bit deeper based on what the interim final rule gives us and what those frequently asked questions give us. So general revenue includes revenue from taxes, current charges, miscellaneous general revenues, intergovernmental transfers between state and local governments. General revenue does not include refunds or other correcting transactions, proceeds from the issuance of debt, sale of investments, agency or private trust transactions, or revenue generated by utilities and insurance trusts. It also does not include intergovernmental transfers or funds from the federal government. Essentially, they have said including transfers made via a state to a locality, in pursuant to the coronavirus relief fund, fiscal recovery funds. And they even include in there that to the extent possible, that recipients really should attempt to identify any funds received from other local governments or state governments, anything that essentially originated from the federal government, really those pass-through funds. The way they word it is it's to the extent possible, make the attempt to identify those funds. I think there's going to be some cases where you just might not know. I think those are going to be few and far between. But essentially they're saying make that effort to essentially identify anything that is coming from the federal government. We're going to remove that from the calculation. The one thing, actually, before I move forward, the one thing I will also point out is interfund transfers should also not be included. So if you have a interfund transfer from, say, a fire tax fund to the general fund, or from the general fund to a capital projects fund, those interfund transfers should also not be included, because essentially you'd be duplicating some kind of revenue depending on what year it is. So those interfund transfers in to any of the funds also should not be included. So the interim final rule, as of June 24th, actually put out a nice, and I tried to make it a little bit bigger and zoom in here on a couple areas. They actually put out an appendix. It's all the way at the back of the frequently asked questions. And what they have essentially done here is nicely color coded red and green. Red means no, green means yes. And essentially here is where they have said revenue that should not be included. And that little chart is down here saying included or excluded. But here's where they're talking about the things I just shared. Those intergovernmental transfers, debt, investments, agency and private trust transactions, utility revenue, which here's an interesting one. So specifically includes revenues from electric power systems, gas power systems, public mass transit, and water supply systems. They also have other examples from retirement systems, workers' comp, et cetera. Sometimes we get refunds, et cetera, from those kind of sources that would not be included. So then we go to our green category. And over here, I want to point out that one of the current charges does include sewer or solid waste systems. So this is one that we weren't sure of at first, is whether or not sewer revenues could be included. This is a game changer for a lot of recipients, and they do include sewer or solid waste systems essentially in their examples of revenue under current charges. And there's things in there also, parking facilities, parks and rec, airports, all fall under the current charges. We've got a whole bucket of tax revenue. Essentially every kind of tax revenue is allowed to be considered under that general revenue. There's other miscellaneous revenue they give us some examples of: dividends and interest earned, donations, fines, lottery, rents, royalties, sale of property, special assessments. Over here, you'll also see here's where the intergovernmental revenue from the states, from your local governments are included. Here's federal government in red. So essentially any of those revenues coming from the federal government should not be included. So again, this is, and I'm gonna zoom back out here. So I'm actually in the frequently asked questions. I'll zoom up to the top here. So this is from the Treasury website. You can see it's as of June 24th. This is the most recent release that they have put out. And like I said, this is really good because it does walk through all of these revenue loss uses, what's considered general revenue. And at the very back is that appendix where it does have those specific examples of what is included. So with that, and again, this is high level, everyone's going to have these unique, well, is this included? Is this included? It's just going to take a little bit of interpretation. And I'll just take this minute to, as a reminder in everything when it comes to receiving special funding and then how we use it, I think documentation is the #1 key here. In however you're going to interpret this guidance, again, we only have an interim final rule at this point, but however you're going to interpret it and essentially then apply it, documentation of that interpretation and essentially the decisions made should just be documented and why. That way, if there's ever a question, you can walk through that thought process. So just a reminder there as far as documentation. But I do want to walk through a good tool that is out there. And this is from GFOA. And this is their revenue replacement calculator. You can find this on the GFOA website. I have this filled out as an example. And so essentially what this does is it very nicely walks you through exactly what to do. So your fiscal year end goes in this top box. It's a nice drop down. My example here is a township. So essentially I've used December as my fiscal year end. Everything that's in white, you cannot change. It's automatically set up with formulas. So it's kind of nice because it's a little foolproof or error proof, which I like to see. So essentially that base year is going to be 12/31/19. The calculation date is 12/31/20. And we'll actually speak to this. There are 4 points in time that we can calculate, and I'll get to that in a moment. But essentially for 12/31/20 is the year that I'm calculating it. So now what it's going to go through is it's going to estimate the revenue. So from the base year, 2019, this worksheet says, use this worksheet to calculate. So this green, as it aligns right there, and there's a nice link, you can click right on it, it goes to this tab. But this right here, it is not identical to the DCED report. We all use a DCED report, but essentially it's related. It very nicely follows along with your DCED report or the DCD chart of accounts. And what this does is you essentially drop in all of your revenue for that base year of 2019. And then there are these little Y's and no's. And essentially right here, this worksheet already knows based on what buckets you put the information in, whether or not it should be included in the calculation. So this is a perfect example right here, intergovernmental revenue. Other local governments, yes, it's included. The state, yes, it's included. From the federal government, no, it's not included. So it is nice how essentially it follows along. Another great example is utilities, water, electric, gas, transit. No, 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 no. They're still encouraging you to input the information. So essentially you can tie back to your report, which I think is nice to make sure you're capturing everything. But then essentially at the very bottom, it's going to have total revenue, which you should be reconciling against your information. But then it's going to say, here's the amount of the revenue that's included in that quote unquote general revenue category. And that's then what is going to carry forward to the summary page as the base year. The growth rate then in here is 4.1%. Remember, everyone can use 4.1%, but if you want, and I encourage everyone to go through the calculation to see, are we higher than the 4.1%? The growth rate tab walks you through that. So what's nice here is it actually carries over the base year of 2019. So you enter the same information for 16, 17, and 18. That is then going to automatically calculate the growth rates. Essentially for this example I have, their growth rate was 2.8%. So that's where the worksheet says, nope, we're going to use the 4.1% because your actual average was lower. And that's why it pulled over here that 4.1%. But if this would be 6.3, it would then pull over the 6.3%. So I definitely encourage everyone to go through that exercise, because you never know if you have higher than that 4.1%. So they've taken the base year, they've taken the growth rate. We now have this, what I'm calling the predicted 2020 rate. And then the last piece is to enter the actual rate for 2020. And that's the very last column, same exact format, which is super nice amongst all the tabs. You just drop in all of the information there. Again, it's going to pull over, I'll go to the bottom here. It's going to pull over the actual amount that's considered general revenue. And then it's going to essentially say, in this case, this example had a reduction in revenue of about $47,000. So in this example, this recipient has $47,066 of their ARPA funds related to calculating the lost revenue for 2020 that they can use in that much broader category, which we will get into as far as what's included in that broader category. So I'm just going to finish up my piece here, and then we'll see if there's any questions, because I know it's a lot of information, but I have three more slides here that I would like to go through. Make this bigger here so everyone can see. So a couple additional items to note. General revenue or revenue loss should be calculated on an entity-wide basis. It's your recipient as a whole, less anything that doesn't fall under general revenue. A good example of a discussion I had on this is I had a client that had no recreation program for 2020. I mean, that was a huge loss in revenue for recreation. However, we can't just take that piece of it and consider that lost revenue. That recreation revenue is included in the general revenue calculation. So it's one calculation for the entity as a whole. Recipients are not expected to demonstrate that the revenue loss is directly related to COVID-19. That's in the frequently asked questions. Essentially, it is assumed that any revenue loss is based on some direct or indirect effects of COVID-19. So you don't have to be going back through and identifying, well, the taxes went here and this went there. It's in total and it's assumed. Revenue loss can be calculated at 4 points in time. So 12/31/20, we can calculate now. We can calculate that revenue loss for 2020. However, we still have 3 more periods of time where we can calculate lost revenue based on that 4.1% growth each year. In the GFOA template that I was using, it does it for you. So when we get to, say, January of 2022, and I'm going to run that same calculation for that same recipient, I'm just going to use the drop down for 12/31/21. And now on the tab where I put in the actual revenue, I replace that with the 2021 actual revenue. And so the point of this is there was a big impact in 2020, but there are and will continue to be impacts on our recipients because of COVID-19 over the next couple of years. So there will continue to be opportunities for potential revenue loss based on that. Audited data is not required. However, the Treasury does expect that all information be complete and accurate. So if you've got an audited DCED report, the numbers you're using really should be tying to that audited DCED report. Now, I would also hope your internal reports match that DCED report, but again, just to make sure, it's not that you have to wait until an audit's done. If your 2020 audit is not complete yet, not a problem. As accurate and complete as possible. And what basis? So really it should be a basis of accounting. It really should be calculated using your current basis of accounting. So if you're cash, accrual, modified accrual basis, you can do any of them, just stay consistent. And essentially, however you start calculating should be how you calculate it all the way through the covered period and until reporting is no longer required. So I don't know of a situation where it would be beneficial to not be in line with your regular basis of accounting when you're doing your reporting, but essentially they're saying you can provide that data on any basis as long as you are consistent. I'm just going to jump into then, and Sam or Marie, please feel free to jump in here as far as, all right, we've calculated revenue loss. Yay, we have some funds that we can use in this broader category. What does that mean? So essentially what the interim final rule is saying, and you've got to love this line, includes but not limited to. So here are those uses that you can use those funds towards. Maintenance of and building of infrastructure, including roads. Modernization of cybersecurity, including hardware, software, and protection of critical infrastructure. Health services, environmental remediation, school or educational services, police, fire, and other public safety services. What it cannot be used on, and it's very much, it cannot be used on these items. There's no wiggle room here. Interest and principal payments on outstanding debt, fees or issuance costs of any new debt, so pretty much nothing related to the debt. Replenishing any rainy day or reserve funds. This is one that a lot of people have been like, wow, you know, we had to dip into our fund balance. Can we replenish that? Not necessarily. You can't specifically say I'm using $100,000 to replenish my fund balance. Paying any settlements or judgments, and it cannot be used towards pension payments. So no deposits to pension funds. So I know that I just gave you a lot of information as quickly as possible, but tried to at least dig in a little bit deeper than I think we have in the past. We finally got a little bit more information. And again, that template from GFOA I think is great. So I'll pause there, I guess, and see, do we have any questions that we want to try to take care of now? If not, Sam, I can hand it back over to you to dig a little bit further into what's allowed as far as uses of the funds.
And Krista, I'll just note if folks are typing questions or they're formulating the question that they may want to ask about revenue. So we saw the list of things that the revenue replacement funds can't be used for, but there's a paragraph in the FAQs that I think is very helpful. And we talked about this when we were preparing for the presentation. It's really about how you allocate the funds in what buckets. So while you can't use revenue replacement funds for a pension payment or debt service or replenishing a reserve, you're not precluded from using other sources of funding that you may have from your tax revenue or other revenue sources to make that pension fund payment, to contribute to your reserve fund, to pay debt service. So it's all in how you show where these funds directly go. But if you have tax revenue that you want to deposit into your reserve account, you can still do that.
Yes, there's definitely an indirect benefit. You just want to make sure that you documented the direct usage of the funds and that they are allowable.
One other point too on the revenue replacement funds, the use of the funds for revenue replacement has to be forward-looking. So we're referencing this March 3rd, 2021 date quite a bit through the presentation today. Those funds have to be incurred after March 3rd, 2021, if you plan to use those revenue replacement funds for those costs. The other thing for some of the accounting folks out there, you can use your revenue replacement funds for other post-employment benefits. You probably want to talk to your accountant to make sure that you've got those properly categorized. But that is an eligible use of the funds. Great. Okay. So think CARES funding, think capital improvements to enhance mitigation or pandemic operations, those types of things that were eligible under the CARES program, assistance to small businesses, direct assistance to households. And interestingly, in the ARPA funding, impacted industries that were hit particularly hard, such as tourism, travel, and hospitality, there's a direct ability to use funds for safe reopening and uniquely fund a planned expansion of upgrade of tourism, travel, or hospitality facilities that was delayed by the pandemic. So if you're able to document that there was this planned expansion and you've got actual material that you can look to that, yes, we plan to do this, it was delayed because of the pandemic, you can use ARPA dollars for that particular use. Qualified census tract. We're going to talk about that a little bit. I don't want to spend too much time on this, but there are expanded uses available within a qualified census tract. That's a tract that's been designated by HUD as meeting certain criteria. I have a link to the qualified census tract information from HUD here, and I'll pull up an example momentarily. In a QCT, certain uses are presumed to be eligible. So uses that address health disparities, so think community health or nursing programs, community violence intervention, which we'll talk about under another topic as well, housing disparities, affordable housing development, housing assistance, housing services, addressing educational disparities. So that's early childhood learning, tutoring, some after-school program to help get kids back to where they should be if they've suffered because of the pandemic, and then some general childhood welfare programs such as summer youth programs, camps, recreational programs as well. So I pulled a snapshot of QCTs kind of within the central Pennsylvania area. I didn't get everybody. I wanted to make it somewhat visible, but you'll see the QCTs that are designated in the purple shading on this map. So there's a lot of communities that don't have a QCT. They're kind of concentrated more in the urban centers. So when we look at the map, we see Hanover, Gettysburg, Chambersburg, Shippensburg, a little bit of Newville, Carlisle, and then kind of the greater Harrisburg area where you've got these pockets of the QCTs. The uses that are presumed eligible may not solely be limited to a QCT. So again, getting back to Krista's point, document, 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 the guidance provides that if you can demonstrate that you will be serving a population, household, or geographic area that's been disproportionately impacted by the pandemic, then you would be able to provide those services that you can provide in a QCT to that geographic area, household, or population. You should use data to document that. How did you arrive at the conclusion that this is serving a disproportionately impacted area? And then you should also make sure you look at the interim rule for some guidance. There is a lot of scholarly data in the interim rule that talks about how they determined that there were certain geographic areas or households that were disproportionately impacted. So use that kind of as your base source of information, and then apply that to your community and see if you can establish an area that may be subject to some enhanced uses because of a concentration of population of folks that will qualify for those services. Kind of an open question, could you use the CDBG eligibility of a census tract to be a qualifying factor? I think perhaps. We don't have clear guidance on that. Hopefully Treasury will provide some additional information, but that's a good indicator of pockets of economically disadvantaged folks. But again, make sure you lay out your logic. I'm going to go over these broad categories pretty quickly. You can use funds for personnel if you've got back to work incentives for unemployed folks, rehiring public sector staff to pre-pandemic levels. So not above and beyond where you were at the time of the pandemic, but back to where you were, the baseline that was the staffing level before the pandemic. The really interesting one, premium pay. So you can fund retroactive payments for work performed since the start of the pandemic. It has to be for essential workers, which includes most government workers, can't exceed 150% of the greater of the state or county average annual wage. I've got a link to the BLS information there that you can check out to establish the Bureau of Labor Statistics information that you can use to establish what those annual wages are on the county level and state level. And the key there, again, that March 3rd, 2021 date, you can't have incurred that obligation to retroactively pay those folks prior to March 3rd, 2021. But sitting here today in July, if you're in collective bargaining negotiations with some of your essential workers and you want to use premium pay as perhaps an incentive to get the contract done or as an economic piece of that, that's a potential use. Law enforcement, unfortunately, communities haven't been given a lot of flexibility in the law enforcement realm. You can rehire officers at the pre-pandemic level, and in communities that can document an increase of violence or difficulty in accessing or providing services due to the pandemic, you may be able to hire new officers, but the use of those funds have to be directly related to community policing strategies and offsetting an increase in gun violence that's associated with the pandemic. So again, very data-driven, fact-specific for the community. I did include at the end of this slide, if you say, well, what's community violence intervention? I included a link to the White House briefing on community violence intervention initiatives. So that will tell you what the White House kind of sees as eligible community violence intervention programs, and you could use that in tailoring whether or not you've got a program that may fit within that use. Spend a minute here because I think there's a lot of folks interested in sewer, water, stormwater. We had a question on that earlier. Again, the key dates, it can be used for projects that were planned or started prior to March 3rd, 2021, but the costs have to be incurred after March 3rd, 2021. So again, if we're using the CARES Treasury threshold for what is a cost that's incurred, that's an obligation to pay those funds by contract. So if you've awarded a bid for a project prior to March 3rd, 2021, it's likely not eligible because you've already incurred that payment obligation. Must be eligible under the Clean Water State Revolving Fund and the Drinking Water Fund. I will go through those quickly. This PowerPoint will be available for you to take a look at if you want to. Treatment works, non-point sources, decentralized wastewater treatment systems. Stormwater is a big one that a lot of municipalities, I think, are going to use for this. Water conservation, water reuse, energy efficiency, increased security measures, physical and cybersecurity at those water and wastewater treatment facilities, and then technical assistance that you may need to be able to develop or operate those projects. On the drinking water side, treatment, transmission, interestingly, when we get back to the end, storage, uses that are not eligible. I'm going to jump ahead to that slide. Under the Drinking Water Fund, generally the Drinking Water Fund can't be used for the expansion in anticipation of future population growth, but the Drinking Water Fund can be used to expand the system to service underserved populations or populations that may have been otherwise disadvantaged by the pandemic. So those would be in those QCTs or other qualifying factors.
Hey, Sam,
So
can I pause you for a second? Oh,
Yeah.
We have a chat that just came in from Sean Arbaugh saying, if
Okay.
using the funding for design of sewer projects, do you have to go through an RFP process for engineering?
That's a great question. So I do know, and maybe I'll look to Maria a little bit. I don't know the answer to that offhand. I do know that the use of the funds is subject to, let me pull this up here. It's the, I think 2 CFR 200, I think is the section. And so that does have some of those procedural requirements for the use of the funds. Yeah, it's 2 CFR 200. So that's the EEO requirements, that's the Davis-Bacon wage requirements, the anti-kickback. So think any other type of federal project that has those procedural elements, you should follow those procedural elements, but I'll refer to the rest of the team for maybe clarification on that. And Sean, if we can't get you an answer today, we'll make sure that we provide one. Maria, do you have anything you want to add to that?
I don't think so. I was going to reference that as well. I think I'd have to go directly to that statute to look at the rest of the requirements.
Yeah, so just be aware as you're using the funds, the kind of, I'll call them the administrative requirements in the Code of Federal Regulations do apply for the use of these funds. Cybersecurity, Krista touched on that. We already covered that. The other one that I think is probably interesting to a lot of folks on the call, Parks and Recreation. So this was added on June 23rd. This was a hot topic. Can you use the funds for enhancement of outdoor spaces? The answer is a little bit gray in a certain respect. So yes, for sure, in a QCT, the guidance says you can make investments in parks, public plazas, other outdoor spaces that create healthier environments and help mitigate COVID-19. So yes, you can fund summer recreation projects for youth in a QCT. Can you do that outside of a QCT? As I mentioned earlier, perhaps, but you're going to have to document that you're serving a disproportionately disadvantaged community, and kind of that two-part test that we laid out in the beginning, right? Are you able to establish an economic harm, and how does this investment address that economic harm? There's an interesting item that was added on the 23rd as well that said funds can be used to address damage, and this just isn't limited to a QCT, so this is broader. Funds can be used to address damage or increased maintenance needs due to an increase in park use during the pandemic. So if you've seen heavier use of the parks that more than you had pre-pandemic, and you've got some additional costs associated with that, that would be a qualifying use of those funds. Courts, yes, if you're using the funds to address a backlog in cases due to the pandemic, and there's a lot of eviction and housing stability categories that the funds can be used for in the court system. A lot of social services, mental health, substance abuse assistance, housing assistance, food assistance, etc. Broadband, probably not a hot topic for most of the folks on the phone, but there are some folks I think that are considering broadband. There are certain criteria for that you want to make sure you meet. I do want to note that there is another potential source of funding, the Capital Projects Fund that was funded by ARPA as well. It has $10 billion allocated to it. So you may want to, and we don't have any final regulations on that, even preliminary regulations yet, but there may be another funding source there for broadband. Small businesses, again, think CARES style funding and assistance to small businesses. The one thing that's of interest probably to some communities is the update on June 23rd also said that you can assist small businesses in enhancing outdoor spaces for COVID mitigation. So think outdoor dining improvements or improving the built environment of a neighborhood. And this isn't in any district, this just isn't in a QCT. So think facade improvement programs in your downtown, in your Main Street. Some of you have Elm Street programs now. So this would be kind of similar to that. And I'll leave it to Marie on the reporting requirements.
Great, thanks, Sam. Okay. All right, so I'll just go through the reporting requirements briefly so that we can have time for a couple questions. All this information that I'm about to give is from the Treasury's compliance and reporting guidance, which was issued on June 24th, 2001. So just a couple things to keep in mind in terms of reporting. So each subrecipient will have to maintain an active SAM registration. So I know all of you had to go through having a SAM to be able to access the funds. So this will need to be updated annually. Maintaining records, like Krista mentioned, document all of this. All those documents will need to be maintained for 5 years after all the funds have been expended. Just a general note that recipients and subrecipients that expend more than $750,000 of federal funds during a fiscal year will be subject to an audit under the Single Audit Act. And also, Treasury is going to be issuing a user's guide specifically on the reporting requirement side. So we expect to see a lot more detail and a lot more guidance on the specific reporting requirements soon. I'll also just note on administrative cost eligibility. Recipients are allowed to use ARPA funds for administering these programs, including the costs of consultants to support effective management and oversight, including consultation for ensuring compliance with legal, regulatory, and other requirements. So my suggestion to you is that if you're using any of these funds for admin or legal costs, that any invoicing specific to the ARPA in that manner should be clearly delineated from other routine admin or legal costs that your municipality or county has. This slide shows an overview of the reporting requirements by recipient type. So all the larger states and cities, counties with the populations higher than 250,000 residents will have to submit an interim report by August 31st of this year. So if you're in a non-entitlement unit, you won't have to do that interim report. Project and expenditure reports are submitted either annually or quarterly based on your entity type, starting October 31st. And then the recovery plan and performance report, this is really specific to the state and those much, much larger entities, and that will be an annual report. Just to give you a brief overview of those types. So if you're not a NEU, you'll have to submit an interim report by August 31st. This is intended to provide an initial overview of the status and the uses of funds and is a one-time report. So this is where you'll include your revenue replacement data calculations that Krista talked about. The state will also provide detailed information on all of its distributions to the non-entitlement units. Everyone's going to submit project and expenditure reports. The NEUs will report annually and all others will report quarterly. So these reports are going to provide a lot greater detail on the projects that you've chosen to fund with your ARPA money, any sub-awards over 50,000, and specific information based on the category. So information that you would include would be a list of all your projects and their corresponding expenditure category, which I'll get to at the end. You'll provide a brief description, a couple hundred words, project status information, demographic information if you're targeting those qualified census tracts, or any specific expenditure category where they want to target whether or not the program is serving an economically disadvantaged community. You'll also provide information on any subawards that are made that are greater than or equal to 50,000. So if your municipality decides to set up a fund to help small businesses, you make awards greater than that amount, you would have to provide detailed information on how that sub-recipient is going to use those funds. There's also a section for a narrative describing your compliance with the Civil Rights Act, and then other detailed programmatic data information based on the expenditure category. So for example, if your municipality decides to provide assistance specifically to households, you would provide a brief description of the setup of the program, the number of individuals served, and your thought process and methodology behind why you've chosen to provide assistance to those households, how it meets that two-part eligibility test that Sam talked about in the beginning of responding directly to COVID. There's also required data specific to the water, sewer, and broadband projects. So schedule, location, additional, I'll note that there's additional information required if your project is in excess of $10 million. You'll also provide information for water sewer projects like your NPDES permit number, your public water permit system number, and for broadband, additional details on the speed, the cost per mile, and the households and businesses that are going to be served by that new broadband infrastructure. And then lastly, the recovery plan performance report. I think most everybody on this call doesn't have to worry about that because it's your much larger entities in the state. Essentially a long-term look at how the ARPA funds are being used in the economic recovery process. And then lastly, I wanted to show you this table, which shows you all the allowable expenditure categories. So I know we talked a lot about number 6, the revenue replacement, because that's the most broad and general in terms of allowing flexibility for the funding. But these are all the other categories that you'll be asked to line your projects up with. The small asterisks denote projects that the recipients must identify the total amount of funds that go towards evidence-based interventions. And that's where using that data in the interim rule for the evidence-based is very important. And then the little tent one is specifically uses of funds that either serve or don't serve economically disadvantaged communities. And so that's what I have on reporting. I think we have a couple minutes for questions, Sam.
We do, and if we run over a little bit, I think we're good to hang out for a couple minutes over. So if you've still got some questions, we'll endeavor to answer those. If anyone wants to unmute themselves and ask a question, feel free to do so, or provide us a question via chat. We'd be happy to take it that way as well.
Sam, I just want to jump in on 2 quick things that I thought of while both of you were speaking. First one, in regards to the single audit, as Marie said, that's $750,000 in one fiscal year, total federal funds, so all sources. So if you had funds from FEMA, pass-through money, all of that would need to be added together. If you've never been through a single audit, it is a lot of additional information that is required, compliance requirements, etc. So definitely be thinking about that as early as possible. If you have the opportunity to split your funds over several years where you never hit that $750,000 threshold, you might want to consider the benefit of doing that to not have to go through the additional audit procedures and requirements. Not saying you don't have to comply with the standards, but just to kind of put that out there. The other thing is I have heard a lot of counties are specifically doing programs related to business revitalization. And so any of the recipients that are lower than a county, essentially that might be getting funding from the county, I've heard some counties saying, hey, reach out to us if that's something that you as a recipient would like to be using your funds towards, because you don't want to duplicate efforts. And so there might be the opportunity to really maximize funds from whether it's the county or you as a recipient to be working together. So that is one thing that I have heard. A lot of counties are looking at that. So to reach out and kind of work together as possible.
So we did have a question. Are we aware of any limit on administrative expenses? And that's probably based on, we'll probably recall the CARES funding had a limit of, I think, 2% in the use of those funds. I am not aware, and Marie and Krista can clarify if I'm incorrect. I'm not aware of any stated limit in either the rule or the facts on the administrative expenses.
I agree. I just brought it up in the FAQs, and it does not speak to any limit as far as dollars.
We received another question, and the question is, in regards to employment training, we lost CDL drivers last year who were older and did not want to risk their health. Can we use these funds to train new CDL drivers? So I'll touch on that very briefly. So in the personnel side, I do know that funds can be used for back to work incentives for unemployed or underemployed workers. So those are folks who are currently not employed or who are working less than full time. You could also rehire public sector staff to the pre-pandemic level, which may involve, shuffling some buckets around that you're able to use some of the funds to allocate towards training. But as far as directly funding a training program for CDL drivers, I look to Marie and Krista. I'm not certain, based on the guidance that we have now. I think if you've got some evidence-based data, right, that that particular industry was significantly impacted by the pandemic, and you're using those funds in a way that address that impact, perhaps. But I think that's going to be more of a data-driven decision.
And I think it also would be dependent on what the CDL drivers are doing, what their job is, and how that fits into the different buckets. So that also might be a little bit more telling in where you could use that.
Mm-hmm.
And speaking of buckets, again, getting back to revenue loss, the reason we spend so much time on revenue loss is it is the absolute broadest category. And so while you may use your revenue loss funds for government services, it may free up other funds that you have to do something like this, to funnel funds towards training folks who can step into that CDL position.
Mm-hmm. Sam, I did get another question. We are currently in desperate need of a new maintenance shed and do not have a meeting room that suits the social distancing issues. We rent our township office and need a new space. Would any of these funds be available for this project? My initial reaction is I think this falls under your revenue loss category for sure, because one of the uses that they say is in regards to infrastructure. I'm not sure that the maintenance shed or township office due to social distancing would fall under any of the other categories. Without knowing more, anything jump out to either of you?
No, there's the portion of the guidance that says that you other than water, sewer, stormwater, and funds that you can use under revenue loss, you can't really use the ARPA funds for general maintenance of infrastructure. So I suspect that the maintenance shed would likely fall under that category. As far as the municipal building, there may be elements or pieces perhaps that would be eligible. So new ventilation system, different things like that you may be able to pull out. But I think if it's characterized as just a general expansion of the municipal building, I don't know that would be an eligible use under current guidance.
I would concur with that, Sam. I think portions of that municipal building expansion would probably fall under the public health category. The capital investments to public facilities directly responding to COVID-19. I think, like you said, ventilation, maybe a little bit, the social distancing could be categorized as that.
And again, back to the data, I think you maybe have a better argument if pre-pandemic you were having 50 people attend your meeting and you've got a meeting room capacity of 50 or whatever, and folks are shoulder to shoulder, and it really inhibited operations during the pandemic because you had no ability to social distance. I'm not saying that would make it eligible, but I think those are the types of considerations that you'd want to go through with your consultants to see if you could shoehorn it into that.
Yeah, I would, especially since they said they rent their township office. So they might also be limited in what they can do since it's not their space. But
Yeah.
definitely, I mean, there could be possibilities. So don't lose hope. It just take a little bit more digging.
So we got another question. For providing government services related to revenue replacement, are there any supplanting concerns? Do the services need to be new, or could we use funds to pay for existing services? No requirement, unless the other folks, Krista or Marie, no requirement that they be new services. It can be existing governmental services that you currently provide.
I agree.
There's a good measure if you're wondering, you know, what is a governmental expenditure. Referencing back to the Census classification document, as Krista referenced, there's a classification of revenue, but then there's also a classification of government expenditures. So if you're wondering whether a particular use may be a government expenditure, you can look at that Census classification manual to see if it fits within there.
And if you go to the Treasury's website and go to the frequently asked questions document, there's actually a link in there to the Census Bureau's manual that has all that information, because they just frequently refer to it. So you can get to that information from that FAQ document.
So I'll throw this out there, and I'm not closing to additional questions. If you have some, please ask them. But if you feel that it may be worthwhile to have another lunch and learn in the future, and if you've got any particular topics that you would like us to focus on, for example, water, sewer, stormwater, et cetera, we'd definitely be happy to accommodate that if we get feedback from a lot of people that would be useful. We want to try and make sure you've got great information and help out the municipalities. So your feedback is important to us. Any audio questions for us? So it doesn't sound like it. I really, Krista, Marie, I appreciate all the time and effort that you put into this. I think we had a really good discussion. It's very clear there's a lot of information. We kind of just scratched the surface of the information today, but I look forward to a future discussion that maybe drills into some of the details on some of these specific categories. Thank you all for spending your lunchtime with us. Hopefully you did get a chance to eat something. Apologize for the technical snafu that we had midway through, but we resolved it and we moved on. So have a great day, everyone, and I look forward to talking to you soon.
Thanks, everyone.
Everybody.
Thank you.